see there the beta coefficient. The overall return on the market portfolio of risky assets is 11%, and this is expected to continue for the foreseeable future. Required, they want us to give them the current return and the portfolio beta, the current, or rather the portfolio current return and the portfolio beta. And then number 2, determine the assets which are inefficient, efficient, or super efficient. So this is a good examiner who is wishing me success, and I should be able really to take advantage of his mercy of giving me this kind of a question to ensure that I get all the marks. I get all the marks there. So they want us to give them the portfolio current returns. Ladies and gentlemen, remember a portfolio is a combination of what here? Investments. So when they talk of the current portfolio returns, what I will do is to take the returns of the securities, that I have, the securities which I had to combine to get these particular portfolios. So I combine them by taking the weights which they have times their returns. So in short here, I will come and take the weights of the securities. I multiply this with the current returns of the securities, and then of course I'll come and sum like that. So J is a number like security 1, etc, etc, etc. So in short, ladies and gentlemen, for me to be able to get the current returns of my portfolio, in this particular case, I will take the weight of A times the return of A given there, plus the weight of B times the return of B, plus the weight of C multiplied by the return of C like that, plus the weight of D multiplied by return of D. And of course, very many students in this sitting forgot the risk-free asset. It's still an asset to you. It's going to contribute some return onto your portfolio, So we have here the weight of the risk-free. I'll call just it R. Weight of the risk-free, multiplied by the return of the risk-free like that. So many students, ladies and gentlemen, forgot the risk-free asset. They forgot the risk-free asset. Remember, weights must always be point something. You can forget about the percentages of returns, but weight must be 0.2. Like the first one is 0.2. So what do we have there? We have the weight of A is 20%, 10% like that. So very fast, ladies and gentlemen, the weight of A is 0.2 multiplied by the current return of A, which has been given there as 12. Plus, ladies and gentlemen, we have the weight must be point something because the total weight must always add up to 1. So we have the weight of B is 0.1 multiplied by the current return of B, which is 18. Plus we have here 0.15. 0.15, ladies and gentlemen, times 14. Plus what do we have here? 0.25, ladies and gentlemen, times 8. Plus lastly, we have the risk-free asset whose weight is 0.3 times the risk-free asset rate of return that I'm able to see there is 5. So could you kindly give me this figure? Which question? We are doing May 2014, question number 1, May 2014, question number 1. And if you happen to be having this revision kit, we are looking at page number 71. I hope you've been able to get that question. May 2014, question number 1. May 2014, question number 1. May 2014, question number 1. So could you kindly give me this answer? What do we have as the current return of my portfolio? The most important thing was for us to remember that a portfolio is a combination A combination of who? Investments. So what I'll do is to lump together all the security returns. But of course, I just don't add them that way. I have to introduce the concept of what here? The weights. The concept of the weights. So I have to take the weights. Remember, this one is quite similar to what we always do here, like the expected return of a portfolio. Expected return of a portfolio, we can remember, we normally take like weight 1 times the expected return of the first security plus weight 2 multiplied by expected return of the security etc. So here the examiner just twisted the language and asked students to calculate the current returns of a portfolio, and because of that just change of the name, so many students in this case here were thrown offside. So many students were thrown offside, and I don't really understand why most of these examiners of AFM are able to throw students out of the bus, the bus in this case that is heading towards success, towards passing. Very many students are normally thrown off the bus simply because of fear. You get a student telling you that, Mwalimu, I've done this paper like 4, this is my last chance. If I fail in this one, I'll be able to repeat everything. It's because you fear. AFM is the simplest. Amongst all the papers that I teach in CPA, AFM is the simplest paper. The approach, the moment you just understand, get the proper concepts here and there, then you practice a little bit, you will be able to pass very easily. So I would want somebody to give me this answer. What is this current return of the portfolios and gentlemen, so they can move forward? Remember, I don't carry a calculator to my classes simply because it is my very best way of involving you. Remember, this is supposed to be a two-way process, a two-way exercise. It's you and myself here. Yes, Esther. Very good. Esther tells us 8.3. So the current return of the portfolio is 8.3. You can decide to leave it like that, or you say 8.3 what year? Percent. 8.3%, one and the same. There is no examiner will penalize you like that. Now, ladies and gentlemen, let us now go straight away to the juicy part of this question, where they want us to assess the assets given there as to whether they are efficient, inefficient, or super efficient. So if you look at Roman 2 of this question, they want us to determine the assets which are inefficient, efficient, or super efficient. Ladies and gentlemen, efficiency analysis is normally executed, is normally carried out using the Jensen's alpha value model. Jensen's alpha value model that I taught you here yesterday. So I would expect you, great students of mine, to remember the basic steps of evaluating the performance of a portfolio or performance of a security using the Jensen's alpha value. Jensen's alpha value dictates that the very first thing you need to do here is to give us the CAPM returns. You give us the CAPM returns. So I would want to see whether there is a student who will be able to give us CAPM. Mwalimu, why are you going out to use CAPM in this question? Why are we using CAPM in this question? We are using CAPM in this question because I've seen beta. CAPM is a model that works if you have beta factors. Whenever you see beta, if you look at this particular column, you can see the beta coefficient. You can see the beta coefficient, ladies and gentlemen, beta coefficient. So once I see the beta coefficient for sure, CAPM will be the best panacea, best solution for this kind of a problem. So give me the CAPM returns. How do I get CAPM returns? The very first thing that I will do to be able to get the CAPM returns, ladies and gentlemen, is to remember the formula. So first of all, remember the formula. So remember the formula. So we have here our CAPM returns over any security, which will be equal to risk-free plus the premium, what we call ERM minus risk-free. So we have expected returns of the market minus risk-free, expected returns of the market minus risk-free, and then outside here we have beta of the security. Outside here we have beta of the security, So then what we shall do, my great students, is to determine the CAPM returns of all those assets, of which will begin with A. So we have A, which will be equal to, do we have the risk-free asset, risk-free rate of return? Oh, yes. If you look at the requirement, they are telling us that the overall return on the market portfolio, of risky assets is 11%. So that 11% to us is the expected returns of the market. So expected returns of the market here is 11. When I continue reading there, I'm not able to see the rate of return of the risk-free asset. However, when I go to my table up there, I'll be able to see the risk-free asset. When you go to the table up there, you'll be able to see the risk-free asset. Underneath the current returns, under the current returns column, you'll be able to see the last return. The last return, which is 5, that is the return which corresponds to the current risk-free asset return. So meaning that the risk-free rate of return here is 5. The risk-free rate of return is 5, like that. So what do we have here for A? The returns, risk-free returns there are 5, plus we have 11 for market returns, minus the risk-free, which is 5 again. Multiply this by the beta of the security, of which beta for A, I'm able to see a figure of 1.5. So could you kindly give us a figure? I would want us, first of all, to be able to calculate the CAPM returns of each security. You calculate the CAPM returns of each security. And for us to be able to do that, remember the concept is quite an easy one. Remember the formula. The CAPM returns formula normally begins with risk-free rate of return. So we have here 5 plus into brackets. Here we have 11 minus 5, close, times 1.5. What do we have from Auma? Sylvia, we have 14. So please go ahead and give me the one of B, C, D, and the rest. So we have here for B, the risk-free rate of return doesn't keep on fluctuating. Neither does the returns of the market. The two will always remain the same. So we have 11 minus the risk-free, which is 5, multiplied by the beta of this particular security. Beta of this security equals who? I can see from this particular table that beta of B is 2. The risk-free, of course, or rather the risk factor will keep on changing. So we have here 2. So please give me an answer for B. And then, of course, I know now you guys are professionals. I know, okay, for B, I'm being told the answer is 17. So I expect you to do the same for C. You do the same for D, and then you do the same for E. Kindly, please do that for us. Please do that for us. So they're getting, already they have gotten from Naomi that we have 12.2 here for D, for C, 12.2. And then I can see D, she has 10.4, the same, ladies and gentlemen, with Auma. How about in this case here, the CAPM returns for the risk-free? CAPM returns for the risk-free. CAPM returns for the risk-free asset. There is a risk-free asset. Actually, it's our E, what I'm calling here E. For the risk-free asset, we have risk-free is 5 plus 11 minus 5, ladies and gentlemen, times the beta factor of this risk-free asset, which is 0, doesn't have any risk, which of course will kill the entire here, leaving me with what here? Leaving me with 5 there. Now, ladies and gentlemen, the moment I have those parameters, now I can easily assess the efficiencies of my securities by use of the Jensen's alpha value. And indeed, I know the formula. I know the formula of Jensen's alpha value. I know the formula that the Jensen's alpha value, alpha of a security should be equal to expected returns of the security. Expected returns of the security minus the CAPM returns of the same security. Alpha is the profitability index. So we have here A, which will be equal to, I want to get the profitability index of A. So I will take the expected return of A. This examiner never gave me expected returns. He gave me the current returns. So the current return of A is 12. So I have here 12 minus the CAPM return of A that I found here, which is 14. Minus 2. This is a loss-making security. And for us here, we know that loss-making securities are referred to as inefficient securities. So it means that A is inefficient. A is inefficient. So please go to B. B, what do we have here under B? Ladies and gentlemen, for B, I will take the return that I'm getting from B, which is 18. So 18 minus the CAPM returns. Remember, CAPM returns, these are basically the returns which will be paying to your investors. This is exactly equal to cost of capital. So I'll talk of 18 minus the CAPM returns of B, which are 17. So 18 minus 17 gives me 1. It doesn't matter how small that particular, ladies and gentlemen, figure is. So long as it's a positive figure, it means that that particular security is a profitable security. And if it's a profitable security, we shall talk of super efficiency. So it means that B is super efficient. 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 Go to C and do the same. So, ladies and gentlemen, see the expected return that I can see from C. The expected return that I can see from C. What do we have there? The expected return, which is the same as the current return, is 14. Minus the CAPM return, which is 12.2. Who can give me this answer very fast? What is 14 minus 12.2? What is 14 minus 12.2? Kindly help us there. 14 minus 12.2. 14 minus 12.2. Somebody is giving me a figure of 1.8. Then, ladies and gentlemen, if it is 1.8 positive, this is so good to us. This is a security that is able to generate a profit. Generation of a profit is not an easy thing. It means that this C is super efficient. Ladies and gentlemen, go to D. So to D, what do we have here for D? For D, ladies and gentlemen, I know the current return. The current return of D is 8. So we have here 8 minus the CAPM return, which is 10.4, which will end up giving us what figures, and gentlemen? Kindly help us there. 8 minus 10.4. 8 minus 10.4, according to AUMA, we are supposed to be getting minus 2.4. And because I can see a loss there, because I can see a negative coefficient, then it means that T is a security that is really so bad for us. It's a security which is what here? Inefficient. It's a security which is inefficient. From there, ladies and gentlemen, we go to E, which is our risk-free asset. Risk-free asset, I can see the current returns are 5 minus the CAPM returns, ladies and gentlemen, which were 5 as well. So 5 minus 5 gives me what here? 0. So 0 tells us, ladies and gentlemen, it's the break-even value for us. So it's a security which is just able to break even. Not profitable, doesn't make any losses. So it means that this particular security is just at the efficiency line. It's just at the efficiency line. So this is what we call an efficient security. Is what we call a security that is what here? Just efficient. A security which is just efficient. A security which is just efficient. Now, ladies and gentlemen, that is the end of this particular question. If you got this kind of a question in an exam, by a show of hands, of course, in this case, if you can't see a hand which you're supposed to raise there, you can just say yes, yes. How many of us were to get this question, all the marks of this question, if this question was to be tested? How many would have gotten this question correct? How many of us? How many of us would have gotten this question correct without cheating us? Without cheating us, how many of us would have gotten this question nicely? Silence means that you guys here could have gotten all the marks, right? Great, great, great. So Naomi says no, but now I believe you've learned. And a good student will be that student who will be able to get some time later on and review. Always Advanced FM, keep on reviewing whatever I teach you here. Whatever I teach you, keep on looking at it severally, and you'll be able to get. Samina says we consider a similar question. A similar question. That will be a bit tricky because I have to cover what I wanted to cover today. Today, ladies and gentlemen, I'll be able to provide this video. If you came in a little bit late, I'll provide this video. Actually, it's running on Facebook. If you go to Facebook, you'll be able to get this video there. I want to believe you want us to repeat, not because you haven't understood, but perhaps because you came in a little bit late, because it's a self-explanatory thing. So allow me to cover, ladies and gentlemen, what I planned to do today, which is the arbitrage pricing model. So mention there, arbitrage pricing model. APM. Some books will call it APT. APT is arbitrage pricing theory. Now, ladies and gentlemen, I would want you to do some curtain raising for Mwalimu here. I would want somebody to tell me whatever information that they have. What do you know about APM? In portfolio, CAPM, this particular topic here, what do we know about APM? Arbitrage pricing model. What do we know about APM? What is APM? What is APM? Anything. Whenever they mention this word arbitrage pricing model, what comes in this case here to your mind? What comes to your mind? What comes to your mind? There is always something that conspicuously will be ringing on my mind whenever I hear of arbitrage pricing model. I will remember this thing, that CAPM, the one that you've just done, is a single factor model, whereas APM is a multiple factor model. So APM is a model that has many factors affecting. So in this case here, we have many factors that affect returns of a portfolio, or a security. There are many factors that affect returns of a portfolio or returns of a security, or returns of a security. Yes, Naomi says multi-factor, yes. Multi-factor. It is, i.e., it is a multi-factor. It is a multi-factor model. 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 If you can recall, ladies and gentlemen, CAPM, which is a single factor, CAPM returns. CAPM returns will always be obtained by us taking the risk-free plus ERM minus risk-free multiplied by beta of a security. So you can see we only have one risk factor there. One risk factor. Beta is a measure of risk. One risk factor defining CAPM returns, which in the ordinary, which in practice is impossible. In practice, that is impossible because in practice, we expect many factors, ladies and gentlemen, to influence any portfolio. And that is where they came and studied what they coined here, the APM what year returns. So for APM returns, what do we have? Of course, all these models here must begin with risk-free. Plus, into brackets here, we have expected return over our security here, given factor one. Given factor one. Expected returns over our security, given factor one, minus risk-free. Multiply this by beta one. The first risk factor. You continue with the same. You come and talk of plus expected returns of the security, given factor two, minus risk-free, multiplied by beta two all the way up to end of thinking capacity. All the way up to end of thinking capacity. That is ETC, etc., etc. So, ladies and gentlemen, if I were you, I would have written somewhere there that this, especially this one, stands for expected return over the security given factor one, given factor one, given factor one, given factor one. And normally, what your examiner will do, if you have been able to write this question down, what your examiner will do is this. Your examiner, ladies and gentlemen, will give you this kind of information. He'll give you factors. He'll give you factors. He'll tell you X1, X2, X3. This examiner will come straight away here and give you expected returns in form of percentages. So they give you, for example, 10. He'll come and give you, for example, 20, right? For example, 25. This examiner of yours will come and give you beta. So he'll tell you this is 0.1, this is 0.7, and perhaps this is 1.2 negative like that. So under additional information, he'll come and tell you the first additional information is that X1 is an energy index. An energy index factor. Energy index factor. Number two, he'll come and tell you that X2, for example, is a foreign exchange. Foreign exchange factor. And then he'll tell you number three, that X3 is a market price. A market price factor, and then number four, of course, you can't forget to give you the risk-free rate of return, the risk-free rate of return, which will be 6% like this, which will be 6%. So from there, ladies and gentlemen, this examiner needs you to do very simple things. This examiner required, number one, Roman 1, he wants you to get the CAPM returns of the security. CAPM returns, or rather CAPM returns of the portfolio. Talk of CAPM returns of the portfolio. CAPM returns of the portfolio. CAPM returns of the portfolio. And then number two, he wants you to get the APM returns. APM returns of the portfolio. 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 Once I see multiplicity of factors being given, I know what this examiner wants to test me about. I know what this examiner wants to test me about. I know that this examiner, ladies and gentlemen, wants me. I know that this examiner wants me, at the end of the day, multiple factors. You would want me to calculate APM somewhere. So I would want a good student to give me the CAPM returns of this portfolio. I would want somebody to try this question very fast and give me the CAPM returns of the portfolio. 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 So I'm waiting. So CAPM returns of the portfolio, ladies and gentlemen, what do we have here? This is quite a simple question. So what I'll need to do is to come and remember the formula of CAPM returns. I have my formula of CAPM returns here. I know that my CAPM returns should be equal to, we have to begin with risk-free, plus we have ERM minus risk-free, multiplied by what here, somebody? Beta of the security, multiplied by beta of the security, multiplied by beta of the security. I hope they're okay. So come here, you see, this examiner has given us many factors. Under CAPM, the only factor that is going to affect us, the only factor which will be affecting us here under CAPM is a market-based factor. So as such, I will disregard any energy index factor in CAPM. I will disregard, ladies and gentlemen, any foreign exchange factor in CAPM. The only one that I will remember, which is quite important for CAPM, is what we call the market price factor. The market price factor. So come here and give us the CAPM returns. So CAPM returns here will be equal to, ladies and gentlemen, we have our risk-free rate. Our risk-free rate has been defined here as 6%. Plus, we have our market-based factor is X3. So X3 returns are the ones that I'll pick as my market returns factor. The one, ladies and gentlemen, that coincides with the market. Remember, CAPM is only the market risk factor you're looking at, minus the risk-free, which is 6%, multiplied by the beta factor of our market parameter. Is negative what here? 1.2. So could you kindly give me this figure? Is negative 1.2, like that. Is negative 1.2. So I hope somebody has been able to pick something out of this. We are saying that CAPM is a single factor, and the factor has to be what? The factor has to be market-based. Don't bring in factors of energy. Don't bring in foreign exchange factors. Don't do that. Don't do that. So could you kindly, ladies and gentlemen, give me these CAPM returns? You can decide to forget the percentages. The CAPM returns, what do we have there? AUMA gives me negative 16 point what here? 0.8. AUMA gives me negative 16.8. Negative 16.8. Of course, this is an arbitrary question. Yeah, just put down to enable us appreciate this concept. Now, ladies and gentlemen, after that, I would expect now a good student to go to the next question and give us the APM returns. Give us the APM returns. APM returns. Give us the APM returns. APM is multi-factor. So now here we have to incorporate in, we have to bring on board many factors. So APM returns will be equal to risk-free plus we have expected return of the security given factor 1 minus risk-free multiplied by beta 1. Ladies and gentlemen, plus we have here expected returns of my security given factor 2, given factor 2, given factor 2 minus risk-free multiplied by beta 2 plus what we have here, expected returns of the security given factor 3 minus risk-free multiplied by beta 3, 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 multiplied by beta 3. So ladies and gentlemen, what you need to do is to come and give us the APM returns, which will be equal to the risk-free rate of return, which was 6, plus the factor 1 returns. Factor 1 returns, I can see they are 10. Factor 1 returns are 10. So we have here 10 minus risk-free, which is 6, multiplied by the beta factor over the first factor, which is 0.1, plus we have here expected returns of 2, which are 20. So 20 minus the risk-free, which is 6, multiplied by beta 2, which is 0.7, beta 2, which is 0.7, plus, ladies and gentlemen, we have here expected returns of security 3, which are 25. So 25, ladies and gentlemen, minus risk-free, which is 6, multiply this by the beta of 3. Beta of 3, which is what here, negative 1.2. So then could you kindly move ahead and give us, move ahead and give us the answer. APM returns will be equal to what here, somebody? APM returns. So I'm waiting for an answer. I'm waiting for an answer. I'm waiting for an answer. The APM returns. APM returns. Yeah, Aum again gives me negative what here? 6.6. Negative 6.6. Negative 6 point what here? 6.6. Negative 6.6. So now I hope you great students of mine have been able to pick a concept here and there out of this. And I would want you at your own time, please have a look at December 2014, December 2014, question number 2A and who? B. December 2014, question number 2A and B. December 2014, question number 2A and B. December 2014, December 2014, December 2014. So we have here December 2014, question number 2A and B. Any question, any question, any question, any question? Remember these early morning classes, I would only want to use them for purposes of giving you a little bit, snippets here and there, like hints, because I expect you guys to be consuming our videos. I want to believe you're watching our videos. I want to believe that these are students who have paid for our videos. And by the way, we have been able to make a very good arrangement with Safaricom, where we shall be able to purchase, our students will be able to purchase 10 GBs for 500 bob. 10 GBs of data for 500 bob. So if you want to know more of this, how you're going to access these 10 GBs for 500 bob, you need to call us, 0719 525,000. That's our number. Yeah, this is quite a breakthrough. Getting Safaricom data 10 GB at 500, that may last you like a month. A month or even two, depending on but we'll be using them to do what here, to watch our videos. And we are also almost getting it at the point of you people being able to watch our videos offline. We want you to be watching our videos offline so that the 10 GBs that you buy, you'll be using them to download our videos onto your laptop or onto your phone. We'll prefer a laptop because of the size, memory. So once you have downloaded them, you can now be watching them later, offline. Of course, what has been disturbing us for quite a long time, we are still under research and development for quite a long time, was this possibility of students, of course, downloading and being able to share. But right now we have been able to know what is to be done. For a student to just download these onto two gadgets, maybe mobile phone or laptop, which will have to give us some credentials. So we help you, you download them. Once you download them, you can never share them. And of course, with your two gadgets, you can't give your friend like gadget A and then you remain with another one. You watch the two of them concurrently. You'll be able to know. And once we know, we will be able to unsubscribe you like that. So this is quite a milestone, but we shall reach there. But the one that you've been able to get is this one of Safaricom, like that. Any questions, ladies and gentlemen, before we disappear? Where can I access the videos for the last class that was on Friday? That one, Samina, you have to look for Mwalimu. You have to look for Mwalimu. You have to call me, and then you'll be able to make arrangements, because I've not yet uploaded this one on Facebook. But you can always make arrangement now that you have our number here. So Santeni Sana, starting from when? Auma, this should be immediate. This should be immediate. This one of 10 GB should be immediate. Okay. Now, lastly, as you disappear, I haven't seen a number of you subscribing for our Advanced Excel. Remember, we have Advanced Excel classes. I know most of us do not know how important Advanced Excel is. Advanced Excel classes, these are very important classes, but I saw one student here, was it Esther? I think Esther paid. Esther paid. So Advanced Excel, these classes are quite important. We're giving you a whole month's Advanced Excel classes where I shall be able to teach you how to use, for example, the pivot tables, how to use macros to record, in this case here, all your formulas, so that in future, you don't have to repeat all those particular steps while you are constructing your model. So that in future, whenever one thing changes, you only go and make a change there, you have the entire thing changing. So we have the ifs, we have the lookups in Excel, etc., which at the end of the day will culminate into what we call financial modeling. Financial modeling is all about business valuation. For those of you who would want to become consultants under what we call mergers and acquisitions. So if, for example, a client wants to come to Africa to acquire a particular business, they would want you to go and forecast. You know the way we normally do our forecast. You tell them, if you're buying this company called RCM Publishers in the past, for the 7 years that has been in business, it has been making these revenues. How about in this case here in the next 50 years, given this particular assumption that the revenues will be increasing like that, the cost as well will be increasing like that. So how do we get our profits after tax? What are the assets that we have? We'll be able to book all those assets in our Excel sheet. Once we have all those assets, depreciation, Go and add back that depreciation. You get cash flows. Come and make an assumption regarding what here, the cost of capital, which of course has to go hand in hand with the average treasury bill rate for a whole year, for example. So once you have that, embed that onto your Excel model, even if it's over 200 years. That is the beautiful thing with this Excel. Excel will be able to extrapolate all those particular parameters, and at the end of the day, it will be able to give you the value of a farm, present value of a farm, which you will be able to use as a very good model of bargaining the price for this particular what-year organization. And of course, according to Excel, this advanced Excel, ladies and gentlemen, there is no way you can go and give just one price for a farm. No, that is why in there, we have got models here, the ifs, which you can use, the indices, index, match, which you can use, ladies and gentlemen, to do our sensitivity analysis. So we do variations. So at the end of the day, we'll be able to advise our person here, tell our investor here that when you go to buy these RCM publishers, know that it ranges between maybe 10 billion to 13 billion, like that. So that as we go to our negotiations table, we'll be able to tell our sellers that, hey, you look here. We are not just coming here. We have done some science. We've been able to get some figures. So ladies and gentlemen, the moment you know how to handle this advanced Excel, like the level that I am at, trust you me, so many doors in this case here will be open for you. We had an offer which ended yesterday. So now that the offer ended yesterday, for those of you who still would want to join us, you'll have to pay 4,000 Kenya shillings, 4,000 Kenya shillings from now today, moving forward. This is the price for advanced Excel. It's still quite low. If you have ever been outside there and you know what people charge for advanced Excel, and yet most of these people don't even understand that, me, I've been involved in the practical aspects of it. So I know. And given that I'm the one teaching you financial management, so I'll be the best place to teach you how to do valuation using this advanced Excel. So this is quite an understatement, ladies and gentlemen. So 4,000, please, if you're willing to join us, remember our pay bill number. Our pay bill number is 402-956-9. That is the pay bill number, account number. You'll write your name, and the cost you are paying for, and the cost that you are paying for, and the cost that you are paying for. Is there anybody who has a question? Anybody who has a question, ladies and gentlemen, regarding what I've just stated here? If there is no one who has a question, I'm looking forward to also be teaching you this advanced Excel. So I expect to see you in my class. In case of any queries, I've already given you our business number. Otherwise, it has been a pleasure hosting you this morning. Remember, this will be about 1 hour. Even next time, next class, early morning class is on Monday. Monday, let's be meeting at exactly 6:10 to 7:10, and then I allow you to go to other things. Is that okay? Otherwise, thank you very much. Have a great day. Let's be productive at our workplaces. Let's be productive and keep safe. Thank you very much. I want to imagine Samina is talking about the evening, the online. Like now we have one tomorrow. That is Thursday. You can join that one, Thursday evening, but it normally runs from 8 p.m. to 10 p.m., 8 p.m. to 10 p.m. Thank you very much for that question. I hope I've answered you. Samina, once you join that one, I'll be able to give you the schedule of the other classes. But I would really recommend this early morning class. It's a good one. Even me, over Corona period, I've even added weight because of oversleeping. Now, you guys have kept me on toes. Great. Thank you very much. Thank you very much. So unless there is any other question, please allow us to end it there. Thank you. All the best. Exams, of course, Naomi, you must be aware there are no exams in 2020. No exams. Why should I cheat you? 2020 in terms of academia, this is a year in terms of academics, we need to subtract. We need to assume like we were not there. And that is why, as a college, we decided, ladies and gentlemen, to have these soft skills trainings. So that when it comes to this, like now AFM, we shall be doing fewer classes. Like now the evening students will only be meeting once only, on Thursdays, once only, to keep you just abreast with what is happening. Because most likely this exam will be in 2021, March. We're just waiting for CASNEB to make an announcement, So for now, just mostly consume our soft skills. Of course, Excel is a hard skill, but very important for an accountant. I can't believe, there are things I don't believe. I can't believe that there is any good accountant outside there who does not know Excel. If you don't know Excel, there is no way you can ever be an accountant. Trust you me. There are things that I always believe in. Number one, Excel is key for an accountant. Number two, if you want to scoop good revenues outside, if you want to scoop good salaries, good consultancy fees, you must be good in this area as an accountant called tax planning. So like myself, what I normally do, even for the years that I taught at Daystar University, when I was full-time there, what I used to do, ladies and gentlemen, is to ensure that if my salary is about 250,000, at the end of the day, I'll work it out in a way that my payee will be very little. So what do I do? For example, if I've got a life insurance, my job is to take to the accounts office, the life insurance policy, the premium, up to a certain amount will always be deducted from my payee. If I'm a member of this home ownership savings plan, right? Whatever mortgage, deducted. So it's always important that you know how to help people outside here reduce on their tax liabilities legally, because you know it is the government which wants people to own homes, to own houses. So I'm not stealing from the government. So legally, so you should be able to be a good tax planner for individuals and a good tax planner for companies. Tell companies that you guys are working for, like now the directors, they need to have their vehicles registered under the company's name. Especially with a single director company. What are you fearing? Have that vehicle registered in the company's name so that whatever fuel you put in there, that's a company's vehicle. You know, when it is your vehicle registered in your name, you'll have to make some arguments with the taxman, like what percentage is business out of this fuel here? Like the wear and the tear. If it's a company's vehicle, all the wear and the tear will be allowed for purpose of what? Your tax. Repairs, everything. So once you're an accountant, like now we have this iTax, which we are training here, where basically, first of all, we will be able to take our students through these tax planning measures in a practical way, and of course, show you how to file. Of course, most of us are aware of how filing is normally done. Filing is never an issue, but how do you become a great tax planner, so that in the future, you don't get yourself in a problem. You know, you get some accountants even cheating their employers to hide the payee. How do you cheat your employer to hide payee? And you know, with this iTax portal, I mean, it doesn't make sense. An employee nowadays is able to know from the other side of the coin how much you've remitted. There is very little you can hide. Right now, the kind of people, accountants who will be adding value to their businesses are now these particular accountants will be able to use the loopholes in the tax laws to plan legitimately for taxes of companies to minimize. This thing of cheating companies that do this and this, no. KRA is really after very many tax defaulters. Don't have your employer being followed. Tell them the truth. But now, right now, where it has reached, there is no way you can hide away some tax amounts. No way. Pay, but of course there is a way that you can reduce them legally. Let me not talk so much in the morning. It's not right to talk so much in the morning. And I hope I've added some value to you people. You know, at times when you realize your mwalimu is not adding value, what you need to do is to tell mwalimu, we are here to study this, not to listen to your speech here. So asanteni sana. Asanteni sana, but most importantly, I hope to see you in my Excel class. Are there students who will be joining me in these Excel trainings? Are there students who will be joining us for these Excel trainings? I know Esther already paid. How about the other students? Will they be joining us really? Okay, great. So I look forward. What is the amount? We said it's 4,000. It's 4,000 Kenya shillings. Okocha, today you are quite late for our class. I never even noticed whether you are around. Kenya shillings 4,000. And then you pay these to the publisher's account. Publisher's pay bill account, pay bill account, which is 402,956.9. And then the account name, account number, or whatever will be your name and the subject that you will be coming for, the course. Sawa Okocha. Tuonane siku ingine sasa. So I look forward in this case here to hosting you great students of mine in this particular session. Thank you.